Hey, welcome to the November 2024 rate market update. Also, this time of year, we start to look ahead to the 2025 forecast. So in today's video, I'm going to go over what we see as far as interest rates, home sales, some questions you might be asking at the dinner table and Thanksgiving. As I film this, it's Black Friday. So if you might be out there shopping, but I want to wait till the end of the month to kind of get for the election to pass and to kind of see what we're seeing in the rate market. And also, I'm going to go over some of, also on these videos every month, I want to go over some reviews, kind of talk about some family stories about behind those reviews, about the kind of the loans that we did for them. Because we do a lot of different kinds of loans here. So, not just, all stats all the time. Because at the end of the day, it's about families. And, the reason why you get a mortgage is to buy a house, to live your life, raise your family, all the things. And if you're new to the channel, again, my name is Emmett Dempsey. I'm a mortgage broker here in Port St. Lucie, Florida, and love to help your family with your next home loan. So just go ahead and like and subscribe and all the things. Without further ado, let's get into it. Okay, here we go. So let's go ahead and take a look here. These are the charts of the mortgage-backed security market. Okay, so effectively, as you may or may not know, mortgage rates are based off of mortgage-backed securities, the trading of bonds on the secondary market. Those bonds are bought by large pension funds, insurance companies, because they have a next to guaranteed return. So how those trade is how mortgage rates happen. So it's not the Fed; it's the trading of mortgage-backed securities. So here's basically the chart. So go back to July. So as prices go up, as green is good. So the price of a bond is more, the yield is less. So what you see as a consumer is a lower rate, but obviously the price of the bond is what we're looking at here. So green is good, red is bad, effectively. So you can see, we had a nice little run up. So we had some sideways movement, and this was going to August and September. We had a brief window of rates. So I did a lot of VA IRRRLs and refis. I did some VA IRRRLs into the high fours. It was crazy what we were able to do as a broker with some pricing incentives. So, and I must have presented at least 15, 20 of them, got them out there, and so many people just wanted to wait. It just blew my mind. They said, yeah, that's good, but let me wait till the election or wait for this. I mean, my advice has always been, if you like it, lock it. Because this happens. So now I have an actual use case. I say, look, you see this brief window of like a couple of weeks, and then you can see end of September going into October, a lot of the bond traders got spooked because what's at the end of September, which is the end of the fiscal year. So the end of the fiscal year meant, having worked in the Army, I know at the end of September, if you had money in your budget, you end up buying a bunch of stuff to justify your budget for next year. That's just the way government spending works, guys. It sucks, but that's just the way it works. Like I remember when I was in Korea, we went and bought like a bunch of lawnmowers and things that just sat in the shed, and that was a higher orders, as they say. So that's what we was ordered to do. So those reports came out, and then after the fiscal year, things just really took a dive. Like all those pricings, and then people would call me back and say, "Hey, you still have that good rate?" Yeah, sorry, it's out of the market. So again, if you like it, lock it. That's good advice. But you can see here's what happened. We were hoping we'd hit a ceiling, and then rates just got worse. These little locks are like lock alerts from MBS Highway from our Barry Habib, great guy. This is what I use for my clients, and it's really served us well. Right now we're in a choppy pattern right now, kind of sideways. We've had some good rate movement after the election. So here's even after the election, it was really choppy. No one knows what direction we're going to go. And further on down this video, we're going to talk about some factors that have to happen for rates to come down. That's one of the questions that we're going to try and answer for you. When will rates come down? But I just want to show you this chart here as to where we're at and where we're coming from. Okay, before we talk about forecast. All right, so let's talk about some of our great client families. Okay, so I love helping many different types of clients. From first-time home buyers, reverses, veterans, investors with DSCR loans. We did a few of those. These are just some of the reviews I'll go over, but it's just many different kinds of loans that we closed just in the last couple months. Like I said, investor DSCR from clients in California moving to Florida, as well as a local senior. Their reverse mortgage. They found me here on YouTube. So we helped that family there. Super happy, and that's one of the reviews. And also several. There was a realtor that was representing a deceased seller that had an inventory of homes to sell. So many of these were lifelong renters. They didn't know that they've never owned anything. They've just been lifelong renters. They didn't know any better. So that's kind of some of the themes we're going to talk about. First is the Dunn family. You can see what it says here. Emmett went above and beyond, make our dreams come true. Fought for us all the way. Kept the constant communication. This is Ken Dunn. He was one of those tenants, and he, on paper, he should have bought a while ago. So it's just they didn't know that they couldn't buy. And it's just, if you have any questions, give us, me or another mortgage broker a call to see what is possible, because you never know. I mean, he could have owned that property maybe a lot longer, he could be an owner a lot longer than he was a renter. So, it's able to do that. It's now the owners of that property. So it's pretty easy because they just bought the house they're already living in. That's, so when you can buy a house and not have to move, that's a win. All right. So let's take a look here. All right. So this is the Maria Arroyo. So she's, our reverse mortgage client. She didn't leave much of a review. She's not really good with tech. So we had to walk her through it. And work with my senior clients, they're either whizzes at it, or they have to meet with me in person and go over everything, and that's it, and that's just fine. But thank you, Maria, for leaving a good review. The next is Schneider family. So they were a sell by. Selling and buying at the same time is super stressful, and they actually came over from another lender. So the realtor was not happy with how they were being treated. We got the great rate, and thankfully they were in great rate window that I was talking about. And he was able to close, and we were able to lock him down. So it was like the stars aligned for them. So it was really good. And thankfully they've also sent some referrals. Unfortunately, we were able to mirror the rate we got for them because of the rate rise. But, always love referrals from our past clients' families. As far as where current rates are, this is from Mortgage News Daily. And I did have a widget on my website, which I'm revamping. So I'm going to put that widget back on there. I'm in the process of consolidating some of my tech stack into one thing. So, kind of pay attention to that. But anyways, so we're in the high sixes right now. You can see where we're at. 15-year fixed, low sixes. Your VAs and FHAs a little bit less, maybe in the low sixes. But again, your interest rate, see what happens when you film. Okay, let's just put that back up there. Okay, but your interest rate will be different. So let's get that in there. Interesting. So remember, your rate will be different. So it all depends on your FICO, your goals, whether you're buying investment property. This is just a general overall average of where rates are. You can see it's a pretty wide range. This is where we're at the end of November 2024. Okay, so let's get into the 2024 end of year, where we're at, what had happened. We're going to talk about 2025 forecast, talk about mortgage rates as well as the real estate market. Okay, so we were just at Thanksgiving. Like I said, today's Black Friday as we're filming this. So you take a look. You might have people talking about real estate. I don't know if I'm going to buy. It's going to crash. All the different questions that you might have heard, over the last few weeks, and you're going to hear for Christmas dinner. So what do you say to these questions? Okay, so I think these are some questions we should be able to answer. Myself as a real estate professional, my real partners, and just I'm sure you as a buyer have these questions. I'm sure you have many more, but let's just break them down to 5 ones. Okay, well, when will mortgage rates come down? What will it take for prices to come down? Will I be able to find a home if I move? Will the housing market pick up next year, and is the market going to crash? There's a whole genre on YouTube about that. Okay, when will mortgage rates come down? That's the biggest question we get. Again, the trajectory of rates, this is from realtor.com, 3 key factors: performance of the labor market, the outcome of the presidential election, any possible reemergence of inflation. Okay, so number 1, the election's over, Trump won, it's done, we move along. So that artificial barrier, I'm going to wait till after the election, that's over with. Okay, so most folks are moving on. But also, I think the biggest one that's kind of not talked about a lot is number 1, which is the labor market. Because until I think the labor market numbers keep on getting revised downward, and I think they're just full of hot air, guys. I think they're BS. I think once because they can't just let go of the rope right away. I think they're going to, revise all these numbers downward along the way. So I think they were kept artificially high for the election. So as the labor market breaks, as the jobless claims rise, it's never great to folks lose their job, but that's what rates, that's going to happen for rates. More people have to lose their jobs and the labor market. So that's what they say, the performance of the labor market. That's just a nice way of saying more people have to lose their jobs. Let's just call a spade a spade. So there's that. Also, inflationary pressure. So if more people lose their jobs, spending constricts and then it takes care of itself. That's why when high unemployment generally tends to lower inflation, because there's not a lot of discretionary income to spend on things. Okay. All right. So, and then this kind of shows it. You can see these job numbers for October, where all the job growth was. Government, just like I pointed out, and of September and going into October, which is where government job growth is really the main sectors that have been growing, whereas your manufacturing and services have been really, really getting hit and taken on the chin. And I think as these revisions keep coming up, these numbers are going to get worse. And at the time, we're going to see, wait a minute, all the real job growth came at the happened in the government sector, healthcare and social assistance and things that are not actually growing the economy. So I think as this starts to change, that's going to change the rates. Okay, so also, inflation's still a little bit high. They said they want 2% inflation. That's a lofty goal. I think from where we were in March of 22 down, when inflation became a real problem, 5.3, we're at 2.7. We're on our way, guys. So it's getting that way. All right. Mortgage rates are projected to decline. We expect rates to go down, but not meaningful into the fours. So like I said, that period in September, like I talked about, that was about as good as we had high hopes. We were on our way, but the Lord giveth, the Lord taketh away. So they took away the little window. So, but you can see we are mildly projecting, but still into the sixes, maybe touching the fives. It all depends on what the forecast is. So good tax are still getting seller concessions for temporary buy downs, 2-1 buy downs, 3-2-1 buy downs. Those are still good options to, especially if you're transitioning renting to buying and high payment jumps. We'll go over all those options, when I have those consultations. Okay. What will it take for prices to come down? What will it take? All right. So let's set the table. You hear all this housing crash stuff and all those things. It's about supply and demand. Well, I think we know that if there's less of something, people want it more. That's why prices are rising as they are. And you say, wait a minute, if no one's buying and labor's this and that, well, this is the major reason why, guys. You can see throughout the 70s, we had close to 1 million units being built. This is single family units completed in thousands. So you can see leading up to 2008, and that's the biggest thing that people want to show is it's going to be 2008 all over again. It's well, you can't really have that. And I'm not even talking about in the demographic piece, because this on top of demographics, Gen Xers, the cohort coming through actually buying up the properties, there were not enough of them to absorb this high supply. So you had the high supply, and then you had, after 2008, you had a big old ditch of no building. So the builders are still catching up. So they haven't even reached back to pre-pandemic levels yet. Okay. So, home prices are forecasted to rise in 2025. The average of all 10, about 2.5%. You can see all from 0.3 to 4.4. So forecasts are just educated guesses based on where they feel certain things are going to break. But the average, mild appreciation, not going to, blow your hair off, so to speak, but still appreciation. All right. So will I be able to find a home if I move? You just said all this inventory is crazy, right? Well, yes and no. So what happened was, more homes are coming to the market. You can see again from 17 to today, that pandemic buying frenzy sucked up a lot of that inventory. You can see from 2019, we're kind of seasonally adjusted. So these waves, a seasonal adjustment. It goes up into September, comes down, and that's normal. What usually happens is seasonality of the market. And you can see in 2020, things just went crazy. It was inventory dropped like a stone because everybody was buying. And then we kind of, settled back into seasonality again, but then, inventory started to accumulate as rates started to rise. So it went the other direction. So we're starting to see some inventory accumulation. Almost 30% more homes actively for sale on a typical day in October compared to the same time in 2023. So that's good. So inventory is starting to ease a little bit. 12 consecutive months of annual inventory growth and the highest count since December 2019. So that's huge. Okay, so will the housing market pick up next year? Let's find out. All right, so more homes are expected to sell in 2025. So the total home sales in millions. So here's where we were. 2019, 6 million, 6.5. This is the pandemic buying frenzy, and I think 2024 is going to be marked as probably one of the lowest on record. 4.6 million. So we're going to expect to be a shade more than that. 5.2, comparable to 2022, maybe a little bit less. But still, folks are with the inventory. I think sales are going to increase. So that's kind of where we're at nationwide for home sales. Of course, it's market driven. Certain states, Florida, where we're at, different markets, even in the same county, you have different markets. So you have to evaluate that. This is just on a nationwide scale. Okay, is the market going to crash? So one of the narratives you might be hearing is like, oh my God, debt's at a whole all-time high. It's like, well, yeah, not wrong. Let's look at the numbers. Sure. Here you go. Here's mortgage debt. Here's auto loan debt, credit card debt. It is increasing. That is a true statement to look at. But you have to look at, they use that to kind of rope around to try and say, well, that means house is going to crash. It's like 2008. We just showed you how, the inventory isn't quite there to cause that crash. We're going to show you why in a minute. Okay. So what I wanted to show here is that home mortgage liability, owner's equity, and real estate value. So the big thing to understand is that there's a lot more equity these days. So you can see here's the debt, and it crossed over in 2008. So we had all those strategic defaults. It's like, well, I owe more than the house is worth. So that for a good while, and up until 2012, for a long time, that was the case. So this is short sale city, everything like that. So, and then it crossed over in 2013 to where we're at now. You can see there's just more equity in order to do something. So worst case scenario, borrowers are not over a barrel. And I think I saw a stat almost half of homes owned free and clear anyway. So you had that, and just to put it into context, you can see side by side, in a housing crisis, you had owner's equity and mortgage debt. You're upside down. So that cost it. Today, you have far more equity than you do debt. You can get back. Whoop. Sorry. So just going back to that slide, you have $48.2 trillion and a lot of equity to do so. You can kind of see it side by side, and why that narrative is just not there. The home's not going to crash because there's just equity. If like I said, worst case scenario, there's equity in the property to refinance, sell it, downgrade. Whereas before you couldn't get out of the property, it was the strategic defaults would cause that vicious cycle that caused the housing crash. That we had. All right, 3 things to expect next year. Total home sales are forecasted to rise. Mortgage rates are expected to come down. Okay, and we have some small high home price appreciation. Okay, so that's probably the answer to the 5 biggest questions. Again, in your situation, if you have any questions or to get your own evaluation to get mortgage ready to buy a home in 2025, definitely give me a call. All my details are in the description. Okay, welcome back. That was the November 2024 rate forecast as well as our 2025 projections. So again, YouTube wants you to watch this video right here.